Thanks again. I'm joined by Michael Watson from Trobe, who many of you know, and Trobe is one of our greatest funds under management aspects of the group, and we've had a 20 plus year relationship with Trobe, and the great thing about it is they've kept their promises and continued to deliver strong income for the clients of the group. And again, Michael has joined us, so thanks for coming on board here, Michael. And tell us what's happening in debt markets. One of the biggest questions that everyone is asking is, are we going to have another interest rate rise, or is it flat, or is it going down? And how will that impact most of your funds?
Sure. Well, that's a great question. I can probably answer that in about 2.5 hours.
Yes.
But I'll try to keep it short. So thank you again for having me. So what's happening in debt markets? Well, what we've seen over really the last year or so as property markets were cooling, we've seen the amount of total loans being written in the market normalise. Obviously, when the property market was running hot, the amount of credit being written also jumped, and now it's coming back down to what is a very ordinary measure of growth in total debt being written in the Australian real estate credit market.
Okay, I didn't know that.
We're talking to there.
Yep.
Now, what's been a real feature of Australia of debt, and certainly in credit being written to Australian borrowers now for a long time, is just how resilient they are. So we've seen through COVID and all the periods since that arrears in the banking sector and arrears in the non-bank sector didn't peak anywhere near as high as some thought they might have, and post-COVID have come down to to what's really ultimately a historically low level. Now, from then, we've obviously had since May 2022, some significant uplifts in interest rates, and that's which can't be avoided and can't be ignored. Also, we've seen the fixed rate cliff phenomenon, where loans that were written in a very low rate environment in a fixed term have rolled off into a high rate environment. And what we've seen through that in that period, which the fixed rate cliff now having all but concluded, and the interest rate cycle now seeming to have peaked, what we've seen is arrears have increased from what are historically very low levels back towards normal bands. Okay. Now, we're seeing that in banks, we're seeing that in non-banks, so right across the industry aligns the borrowers are seeing more arrears, and that's to be expected, but by no means to any level that gives us any cause for alarm within the sector.
Yeah, no, that's very interesting. And the increase in interest rates for a lender who has a higher interest rate product, is that particularly impacting them with your book? So how does your book look? Because you don't charge sort of the 4% to a client. You're charging a premium because they're self-employed, or
Sure.
they're not traditionally getting accepted by the leading banks. So
Absolutely.
How's the arrears for that type of client at a higher rate?
Sure. I can probably address that on a macro and a very focused position. So on a macro sense, credit quality in the Australian market is high, whether it's a bank or a non-bank. And it's high because it's so heavily regulated.
Yes.
You have to write loans that are of high quality almost to begin with as a starting point.
Yes.
As a non-bank lender in the market, we take a very careful look at each of our borrowers' positions on a case-by-case basis. We don't rely on algorithmic lending models or anything like that. We have trained credit analysts who review each and every application to ensure that the borrower is meeting is a sound risk across a whole range of parameters. We go back to the 5 C's of credit and start from there as a starting place. So, as a foundational piece, the credit quality is strong to begin with. As Trobe Financial's place in the market, we focus, and there's a whole range of credit markets, so there's a whole range of credit that you can lend to. A differentiator for us is that we lend to complex prime borrowers. And what that means is they're high quality borrowers with a complex requirement that isn't easily serviced by the banks. Now what that means, we're not a credit score lender by any stretch, but it's a high quality borrower with what we've seen is a credit score which is equivalent almost to that of a Big Four bank borrower,
Yes.
but who needs to speak to the credit decision maker and talk to them through a process, talk to them about an application to explain their scenario, explain why it's complex, and then for us to either take it forward as an application or decline it.
Yes.
So as a starting place, the credit quality is strong. We do a hands-on credit analysis of each and every loan that comes in by different folk within our credit approval team to ensure that it's looked at by different sets of eyes along the way. So that's a wonderful starting point for that. From an arrears perspective, as I mentioned before, the arrears, we started COVID, the COVID period, if you go back a few years, with our arrears at historic lows. The COVID period hit, our arrears didn't hit anywhere near as high as we thought they may have, and have come back significantly since. Now, in the following period where interest rates have normalised in the market, so too have our arrears, but they're within ultimately what is a historic operating band for us, and again, one we're entirely comfortable with.
Yeah, no, very good. And you launched you got lots of products, but you launched a product in private credit markets in the US with Morgan Stanley. How's that played out, and what sort of returns are being generated from that particular?
Yeah, fantastic. So you're right. So last year, we've been looking to bring new product to market for a long time, and late last year, in December last year, we were very excited to launch the Trobe US Private Credit Trust, which was a wholesale offering initially, investing, as you guessed it, into the US middle market private credit. So that's a sector of the market that we feel has enormous tailwinds behind it to deliver income for investors. It launched as a wholesale product. We're looking at the moment, in fact right now we are wrapping a PDS around it, launching it as a retail unit class, TMDs and everything that goes with that. Yes. The target yield for the product that we're bringing to market for the retail class, or the Class B units, will be targeting an annualised yield of 8.5% per annum across the cycle, also on an annualised basis. Yes. We're hitting our yield goals to begin with. Since the product launched in December through to now, we've been exceeding that, which is good for the wholesale class, which is obviously a different target again, but drawing on that same pool of assets.
And Morgan Stanley continues to be the partner, is that right, or have I got that wrong?
Absolutely. No, you're 100% right. So one of the big challenges with our asset class in particular, or any asset class, is finding an origination partner. Yes. So we made the decision, if we're going to do it with the best, and we've partnered with Morgan Stanley. So Morgan Stanley over in the US have essentially the greatest origination footprint in the US middle market for originating these kinds of loans, these kinds of loans in the marketplace. So we know that we've got a wonderful asset origination partner in Morgan Stanley who can deliver us a very targeted, pure play investment into US sponsor-backed direct loans in that middle market space.
Yeah, it appears to me, and I might be wrong, but the US market is, there's a lot of product coming out of the US market in private credit that's paying very high rates, but it appears to me, because you're partnering with Morgan Stanley and you've got a target rate of 8.5%, your risk metrics probably a lot lower than some of the products would be coming out.
Yeah, that's right. And look, we have a very narrow credit parameter for this. We don't want to be, because we have the power of Morgan Stanley as the asset originator, we don't have to create a portfolio which is investing into a whole manner of financial instruments. We know whether we can match our investments with originated assets on the other side. So that's a really wonderful starting point. But also, if you think about Trobe Financial, and in your preamble you talked about the income and the low volatility nature of our products over many years.
Amazing.
So for us, we want to replicate that kind of an experience for our investors and our advisors, so that this is just such a natural adjacency for a Trobe Financial product to bring to market, is one that, at 8.5%, it's an appropriate yield for a risk and return consideration. You can go into the asset class absolutely and get returns that have got a double-digit handle to them. Yes. But to do that, we feel that it's taking a significant step up in the risk curve when, is that necessarily what the investors want? So we're delivering a product which has got really tightly controlled asset origination and profile there, which we think is appropriate. Yes. And one which we are very comfortable with its capacity to deliver that target yield for investors across the cycle, with a lower volatility in terms of income, a lower volatility in terms of the capital profile as well.
Yeah, one of the I haven't looked at this for quite some time, but a lot of people going into the pooled investment, and that sort of sit and forget type investors. You also have the peer-to-peer products, or the sort of the one-off opportunities.
Yes.
You used to release those sort of once a month or once a week or something.
That's right.
How does that work? That's for wholesale investors, is it?
No, well,
or both?
Yeah, for both. So just to unpick what you just said, we have our 12-month term account, which is a product which had its inception back in 2002. It's a pooled investment vehicle. It's presently over $8 billion in assets under management. So it's got a really strong track record of performance right across the cycle.
And nearly all residential?
No, so it's a portfolio of residential and non-residential assets. So the loans that are in that are, across the cycle, say 55% to 60% residentially secured.
Yes.
But then with a targeted spread into other sectors, so commercial and light industrial, vacant land and some development finance, which give it that wonderful yield appreciation.
Pushing the alpha, yeah.
That's right,
Yeah.
exactly right. So there's the 12-month term account, and you'll find that on the Interprac and Sequoia approved product lists as well.
On all the platforms?
Absolutely.
Yep.
So in addition to that, we have our peer-to-peer product called our Select Investment Account, and that allows individual investors or advisors to select individual loans or individual loan investments to deploy funds into. And you can invest as little as $1,000 or as much as you'd like to into individual loan opportunities or investment opportunities, which we place on our website on a weekly basis. I think it's Wednesday at 2 p.m. we refresh the list, and we put across that a range of loans which have a range of different parameters. So that you might find some residentially secured loans, some commercial loans, some loans that are diversified across Australia. So you can look into you can filter by state, by yield, by type, and so on, and select individual assets that suit a return profile and duration profile that suit a whole range of investor appetites.
Yeah, and what's the sort of size of the loans in total? Is there some where someone could take 50% of the pool, or?
Yeah, absolutely. So in the Select Investment Account, we make available. So we make available to investors a portion of a loan. Maybe it's the whole amount, maybe it's a portion of it, and the investor can choose to take as much or as little as that opportunity as they'd like to. So the minimum investment's $1,000. The maximum is the amount which is available on the shopping list ultimately for investment.
And what tends to be the differential in return between sort of the 12-month account, which is pooled and it's got everything, to a selected loan, which you're obviously going to have different risk profiles for each one?
Absolutely. Absolutely.
But what's the range of the select return expectations or aspirations?
Yeah, well, by comparison, so the 12-month term account as at this month, is paying its investors 6.75% per annum. It's a monthly variable rate. And advised investors can also look to get a rebate at 50 basis points. So they're getting around 7.25% total right now.
That's including all the fees and...
That's right, that's net of all fees. Yeah, net of all fees. If you look to the Select Investment Account and jump onto our website now and have a look at it, you'll see opportunities there that begin at around a similar sort of return, that sort of low to mid sevens. That's typically going to be a residentially secured loan. If you look into a commercially secured loan or perhaps a development finance transaction, you might find a return profile which starts with an 8 or potentially a 9 there as well.
Yes, and why don't all of them go into the pool? Why do you have different buckets?
Absolutely. Well, we preach diversification at all levels in our business. So we like to have a whole range of investors. So we have a whole range of different investor cohorts coming to us. We have diversification across our financial advisors with a large number of financial advisors using us across the industry. When it comes to building out portfolios, also really heavily diversified. So we like residential loans and commercial and to have that whole gamut covered, and likewise geographically. And for us, building out portfolios, it's no different. It makes sense for us to have, if we just chucked all of our assets into one pool, well then we have, one pool only, and if there's ever an event or something, it gives us less liquidity optionality by having just one pool of assets. We know that investors also like to have different opportunities as well, and some investors like the nature of the 12-month term account, which is that annual rolling investment that they can invest and monitor but don't have to do much. It's a passive style of investment account for an investor. On the other hand, we know that some investors actually quite like the opportunity to invest into individual assets, take their own role as an active fund manager ultimately, by them selecting the assets and them watching it and them reviewing the weekly shopping list on our website and selecting a pool, their own little pool, if you like, a sub pool of individual mortgage assets that suit their investment appetite.
Yeah, no, it's good. A lot of the advisors like equities in our group.
Yes.
And there was some talk, I don't know, maybe a few years ago, that La Trobe could potentially have a listed vehicle of some kind, listed investment company loan book. Is there any further talk about any of those things, about having an equity traded product?
Yeah, you're quite right. So we are almost at all points in time looking at what might be next for Trobe Financial with our business, with our investments, with our loan products, right across the board. We thought very long and hard about bringing a listed vehicle to the market a few years ago, and we had discussions about it in this very office, if I'm not mistaken. Yes. The market for LITs and LICs ultimately was one which cooled. We still have the capacity to go down that path should we choose, should the market reopen. But at this moment in time, we're focusing on delivering the structure, the strategy in the structures which we have to hand. Yes. And of course, as you mentioned before, with our new products we're bringing to market, looking to bring additional products in other adjacencies to market as well.
Yeah, and the size of the business now and the ownership structure's changed over the last few years as well. So how big is La Trobe now, and who owns it?
Sure. So at last count, La Trobe Financial had total assets under management of a little over $18 billion. That's across a whole range of investors. So we have institutional investors, wholesale investors, and our retail credit offering, which is the credit fund which we've spoken to already. Yes. The credit fund itself, at the start of the year, passed $10 billion in assets under management. Wow. So that's across all the various funding investment options that we have, like the Select Investment Account and the 12-month term account, and the others that fit into that category as well. Yes. So a whole range of funding sources there, so wholesale, institutional and retail. As to who owns it, the business is owned by Brookfield. So Brookfield purchased the business from us in 2022. Yes. I think it was May 20, so actually right on 2 years ago, if I'm not mistaken.
Happy birthday, Michael.
Thank you very much. So Brookfield are ultimately the owner of the business now.
Yes, and Brookfield are enormous, but do you know how big Brookfield are off the top of your head?
When I start giving numbers to things like this, I get them wrong. They're a multi-billion-dollar business.
Listed in the US, or
listed out of the US and listed in Canada as well. Right. Hazarding a guess, it's somewhere around the $700 billion of assets under management mark.
Yeah, no, enormous. And I touched it before, but I'll go there again. Which way is interest rates going from La Trobe's point of view? I know you've got research guys in your office all the time, looking at economists and lawyers and
absolutely
and opinions. So
sure.
What's the opinion?
Well, we look around the market like everyone else does, and we look at other eminent economists and their views on it. It's fair to say that the view of the market and the view of market economists is that we are at a peak rate setting right now. Now, the risk for upside to rates from here is probably greater than the risk to any immediate cooling of interest rate settings, so that would seem to be the case. There's very few economists that are seriously expecting interest rates to increase this year. There's some that are calling for it. But whether the RBA has the gumption to do that, it could be a case that a stitch in time saves nine. Inflation's obviously a little bit stickier than some had hoped. Treasury is very ambitious with its views on the return of inflation to target, and it's relying on a whole lot of things going right to do that. The Reserve Bank still is forecasting inflation to come back into target range sometime in the 2025 financial year. And I think they're probably just going to ride out the cycle and see which way it goes. That would appear to be the case. So we suspect we probably won't expect to see any more increases to the official cash rate, other than to say the risk of it going up soon is probably outweighs the risk of it going down anytime soon.
Yeah. One of the things I've always liked about La Trobe product is that you tend to not suffer the capital loss depending on which way interest rates go.
Yes.
All you do is change your return.
Yes, that's right.
But your returns have tended to be sort of cash plus 3. Is that sort of the 7 and a bit you're getting from the 12-month account? What's sort of the manager's goals,
Sure.
KPIs for themselves. So, they're trying to generate a return higher than cash, because otherwise we just all put our money in the bank.
Yeah, of course.
What is that plus
good
cash
question.
rate return?
I can come at this from a few different ways. So to start with, we were asked about the budget last week and what we thought about the budget and what impact it might have in our business. And that 12-month term account, for example, has now sat through 22 federal budgets across the whole range of different political and economic
Well, the budget was
persuasions.
good. They haven't changed deeming.
Haven't changed
so
deeming.
You're well above
That's
the
right.
deemed rate.
We'll be happy. Some of our investors will surely be happy with that. So it tends to perform across the cycle, irrespective of the economic settings, which is testament to the way it was created when it was created, with the structural guardrails we had in place to accommodate that. I will say to investors who ask, what income profile does it generate? And I'll simply say it generates the income profile over a medium term from the assets within it. Simple as that. The product itself, the 12-month term account we'll talk to as the largest fund within that, tends to move in the same direction as inflation and interest rates, with a lag over time. The gap between the margin between its distribution rate and the official cash rate will move up and down. That's probably not something that we're hugely focused on, to be honest. We're more delivering what the portfolio of loans generates to us, and it tends to be, as you've characterised there, that margin above the official cash rate tends to hold, but it's certainly not one that we hang our hat on as what we're delivering or why we're in business to deliver that to market.
I love the. I've talked about the tortoise and the hare. You guys are the tortoise. Just keep on returning good yields with no capital losses to date. So it's been a magnificent journey from us as a licensee. And thank you, Michael, again for your time. And we look forward to continue to support La Trobe.
Absolutely. Well, I've been here for 11 years, and Interprac and Sequoia were long-time partners of us when I joined. So it's been a pleasure working with you and your team for a long time, and I hope to continue that as well.
Thank you.
Thank you, Gary.